Hello, Mavericks. This is Rob. All right, let's talk about Forex. So when I started trading back in the mid-90s, I started with equities, just with stocks. Day trading stocks is where I started out. I branched off into options in the 99, 2000, and that was absolutely fantastic, and I loved options. I got into futures, and Forex was always this weird market out there. And somewhere around 2006, 2007, I started dabbling in it, and I absolutely fell in love with it. It is by far my favorite kind of trading. Now, when I mean favorite, I mean that this really speaks to me as a person, as an extrovert. It is fast, it is exciting, it is all the time, and it's fantastic. That being said, everything that I just listed as a positive is also a negative. So we're going to go through all these things, but just understand the currency market has so many advantages. And I truly believe, and I tell the people this all the time, if you are going to be engaged in short-term trading, like a day trading style or shorter, there's no better place to be than Forex. The costs are the lowest. The benefits are just the liquidity is always there. There is so much liquidity. It is the most liquid market in the entire world. Trades over $6 trillion every single day. This dwarfs every single other market out there. This is the biggest marketplace in the world by far. Way bigger than the US stock market. It is really, really big. Because of this liquidity, remember, whenever you have a marketplace where people are buying and selling things, how many people are in that marketplace? Number one, ensures what's called price discovery, meaning you know exactly what the price is. And number two, transaction costs go down. You are going to get the tightest bid-ask spreads in the currency market. No question about it. When you talk about, placing a trade, clicking the button, what is your transaction cost? It is absolutely going to be the lowest in the Forex market, bar none. So this is going to be the cheapest place to trade as far as transaction costs go. And the trends are bigger. They're bigger, they're longer. Just think about what we're talking about. This is called the interbank market. This is where foreign exchange happens. Now, yes, we're going to engage in this market as traders, but there are millions of people and corporations around the world that are using this marketplace to exchange currencies. So let's say that there is a company in Germany and they are opening up a factory in Latin America. The company in Germany is going to be using the Interbank FX market to transfer lots of currency from Deutschmarks. That shows you how long I've been doing this for. From the euro to the Latin America currency, and then vice versa. It's just the trends are so big that it really helps you as a trader get on the right side of the markets here. And the last one is leverage. The Forex market offers you a lot of leverage. Leverage is great, but as I said earlier, every one of these positive also comes with a negative. You must respect the leverage that the Forex market gives you. One of the things you're going to be learning here, if you don't know it already, is the concept of pyramiding. We are big believers in pyramiding in foreign exchange trading, is where you take a small position and then you add to it as it goes your way. You need to have extra capital and extra leverage and able to really build up these really nice positions. So Forex gives you that ability. So let's talk about how the Forex market works. It is called the Interbank FX Market. It's called that because all the transactions are done through banks. So whenever you exchange currency, it's done through a bank, a financial institution. Now, if you were to go to Wall Street in Lower Manhattan in New York, there's an actual building called the New York Stock Exchange. It's very hard to get into it now after 9/11, but you could go inside and see all the transactions being done inside that building. The interbank market is not like that. There is no central marketplace. It is the marketplace of all the banks all over the world, all doing business together. When you send an international wire somewhere, that is the interbank market. You're going through the banks. So as long as there are banks open in the world, then the interbank market is open. So let's take a look at the time zones you're going to get. So while it's nighttime in the US and Canada, it's going to be business hours over in Southeast Asia, Australia, Japan, Korea. All the banks are going to be open for business, and they're going to be doing lots of business, doing all their transactions. So we can participate in those transactions. We can be buyers and sellers in those markets. Now, when those banks begin to close, we have other banks in Europe starting to open. So we have banks in France and Germany and the UK, and they are making constant transactions all across the world. So while the Asian banks are closed, you're going to see that the European banks are open. And then once the European bank starts to close down, the US and Canada and North America banks open, they do rigorous business, and we can participate in their liquidity. And then right when the US session banks close down at 5 p.m. Eastern time, guess what's opening up? The New Zealand, Australia banks, and then Japan are opening up right after that. So the Forex market is open 24 hours a day, 5 days a week. So it does close. The last bank closes 5 p.m. Eastern time on Friday. And the first bank opens up at 5 p.m. Eastern time on Sunday. So those are going to be your hours for Forex trading. Now, when you are a stock trader, you get these holidays, you get these days off. So again, they have days off for Thanksgiving. They have days off for President's Day, Memorial Day. That doesn't apply in the FX market. There are only 2 days of the year where banks are closed around the world. Every single country. One is for Christmas and one is for New Year's. Those are the only 2 days out of the entire year, except for Saturdays and Sundays, that the FX market is going to be closed. Now, just because something is open all the time doesn't mean it's a good time to trade all the time. And that's one of the fallacies of the Forex market people hear about, and also the crypto market is, hey, it's open all the time. Well, that's great, but that doesn't mean that you can just sit down and make a good trade in a nice trend all the time. So while it's important to understand all the market hours, we're going to go in depth into when you should trade, because in Forex, when not to trade is just as important as when to trade. There are times during the day that are way better than others for entries and exits. There are times during the days that you really shouldn't be doing anything unless there's some major news there. So again, we're going to go through all these things to make sure you understand there is a time and a place to make trades in the Forex market. Now, the 8 major currencies that we focus on here at Maverick are the Japanese yen, the US dollar, the euro, the Swiss franc, the pound, the Canadian dollar, the Australian dollar, and the New Zealand dollar. Again, these are the ones that have the most volume and liquidity. These are the ones that, again, are not highly correlated to each other. And what that means is that there are, I think, 86 different currencies around the world. That doesn't mean they should all be traded, because small currencies are going to have all the problems we talked about with liquidity. They're not going to be as liquid. They're going to be much more expensive to trade and trading costs. And most of those smaller currencies are highly correlated to other currencies. For example, if you look at a currency like the Swedish krona, sure, Sweden is a great country. They're independent. They have their own currency. But when you take a look at how their currency moves, it is highly correlated to the euro. So they're going to move together. Now, yes, there's going to be periods of time where one will do better than the other, but on the whole, they're going to be highly correlated. And if they're highly correlated, you should be trading the one that has the lowest transaction costs. So we're going to focus on these 8. And like I said, whenever I have traders say, Rob, what about this currency? What about this currency? I can pull up a graph and show them that there is a major currency that is highly correlated to the price action. And because of that high correlation, it doesn't make any sense to trade these smaller currencies. So this is a caution to everybody. There are many other currencies that can be traded. It doesn't mean they should be traded. Stick with the major 8. There are plenty of trading opportunities in those major 8. When I first got into Forex, I remember thinking, okay, well, trading is trading. Everything is just a symbol and a market price, and that price goes up and down, and you make your decisions off a chart. And while that is true, and I always use the term trading is trading, the mechanics of that are no different. Whether you're trading a stock, a bond, a future, a currency, a crypto, it doesn't matter. Everything is a symbol and a price and a chart. However, when I got into the world of Forex, I was like, wait a second, I don't understand any of this terminology here. And I actually had to learn about a lot of things like, what is a cross? What is a pip? How does the margin work on it? So we're going to go through just the basics of Forex terminology. If you've traded Forex before, this is going to be very redundant for you. If you haven't traded Forex before, this is just going to help you when you get into the world of Forex to not get stumbled up over some of the terminology here. So let's talk about what a cross is. Now, as we talked about in pairs trading, every single currency trade is a pairs trade, meaning that you must have 2 currencies, one that you're long and one that you're short. A cross is simply that combination. So let's say in your analysis, you looked at the euro, it looked very bullish and was likely to go higher. You looked at the yen, it looked bearish and wanted to go lower, and you wanted to trade this pairs trade. The symbol you would trade would be the EUR-JPY. That is the currency cross. So whenever you hear us or anyone else talk about currency crosses, this is what they're talking about. They're talking about the pair. Now, this is the symbol for the pair. When you go to trade this pair, you're going to enter in EUR-JPY. That's the cross. That's the pair. Once you put that in your software, it's going to say, oh, this is the market price right now, and you can pull up a chart on it and do all of your analysis. So let's say your analysis brings you to the pound looks very strong and the dollar looks very weak. You say, okay, well, this is the pairs trade I want to make. So you're going to just put in GBP USD. That is the currency cross. That is the pair. All right, so let's say that you did your analysis, and instead of seeing the pound as the strongest one and the dollar as the weakest one, your analysis shows you that, wait a second, the dollar looks very strong and the pound looks very weak. So you would think to yourself, okay, well then I need to do US dollar GBP. That is the cross. Here's the problem. That doesn't exist. Now look, it does exist. This pair does exist. However, you're not going to be allowed to trade this pair. Why? Because in currency, you have something called dominant and recessive pairs. So we're going to take a look at this one, the pound dollar. This one has all the volume. Everyone is doing this exchange. Everyone is trading this one. This one is where all the action is. Most currency trading brokerages won't even allow you to put in US dollar GBP. They won't allow it. It doesn't work. We trade at Interactive Brokers, and you can put that pairing in, but it runs through a different trading system. You can only do, I think it's up to like $50,000 worth, and then it says, no, you can't use this anymore. It's really only used for currency conversions. So in the world of trading, you are going to have to understand that you can go short these currencies. So if your analysis showed you that the pound was weak and the dollar was strong, and the only pair you can trade is GBP USD, you need to go short that currency. And by going short, it's basically saying that, okay, if you short pound dollar, it means you are selling the pound and buying the dollar long. Now, if this is new to you, selling short, it's very, very simple to explain. You simply identify the dominant currency pair you want to trade, and you sell it first and buy it second. Okay, now I know that that is not a great definition and an explanation, but as far as what you need to know, that is actually all you need to know. You sell it first, you buy it second. That's it. You don't need to know what goes on behind the scenes. All you need to know is your analysis was short pound, long dollar. So you're going to sell short the pound dollar cross. When it comes to dominant and recessive pairing, here are just some general rules of thumb. Number one, the yen is always recessive. In every single currency pairing, the yen is always the second one. So again, dollar yen, CAD yen, pound yen is always the recessive. Next, the euro is always dominant. In every single pairing, the euro is always going to be listed first. Euro yen, euro dollar, euro pound. It's always the euro. After that, sorry, I don't have any other rules of thumbs. You just got to learn the rest. Once you put them once into your watch list, you understand, okay, this is the dominant one, this is the recessive. We have some templates you can download to have all the dominant currencies right in front of you. When you have the exchange rate cross you want, that cross is going to have a price. So if you've chosen euro dollar, you will put in euro dollar into the software. And again, you could go out online. You could even go to the airport and you could go up to one of those kiosks and look, what is the exchange rate of the euro versus the dollar? And you're going to see a number, and that's going to be the market price. And in this example, the market price is 125. Okay, let's talk about what that means. Remember, the first currency is the dominant currency. Now, that is always equal to 1 in the equation. It's always equal to 1. That means if you brought 1 euro to the kiosk at the airport and exchanged it, they would give you $1.25. If you brought 10 euros, they'd give you $12.50. If you brought in 1,000 euros, they would give you $1,250. So the first currency is always equal to 1. One of these currencies gets you how much of this recessive currency. So you can do this with anything. If you were to take a look at, something like pound dollar. Pound dollar, you bring in 1 pound and you walk away with $1.40 or whatever the exchange rate is. So you can see here, this is simply just the exchange rate that you get. Now this exchange rate fluctuates, and that's how we make money in currency trading, is that there's lots of factors, and we cover all of these factors when we go through all of our stuff in the training center that affects what prices do in the currency market. You can see the very bottom one, 100,000 euros. Now, whenever you're trading 100,000, this is also known as a lot, not a lot of currency, even though that is a lot of currency. It's known as one lot. When I started trading in Forex, you had to enter your orders in as how many lots do you want to do? So if I only wanted to do 50,000, I had to put in 0.5 lots in my software. If I only wanted to trade 20,000, I had to put in 0.2 lots. Now they made that change. This change has been done for about 10, 15 years, where you no longer enter orders in as lots. You just enter it in as your dollar amount. So when you take a position in currencies, you just put in your dollar amount. You don't have to worry about it being a lot. That being said, you're going to run into this term, a 1-lot trade, a 2-lot trade. You're going to run into this term, so I wanted to go over it just in case you did, so you weren't confused about what it meant. Now in the stock market, we know that things move in dollars and cents. We live that world. When we go to the store, everything is in dollars and cents. Here's the problem. Currencies are not in dollars and cents. Currencies trade much deeper than dollars and cents. So if you go get a quote on the euro US dollar, you're going to get a number that looks something like this. And you can see that this is well past dollars and cents. This is actually to the 10,000th decimal point percent. So you're looking at this saying, okay, this is $1.15,382. Okay, so we can't say that things move in dollars and cents in currencies because they don't. They move much, much deeper than that. So someone years ago came up with the idea of a pip. A pip means price in percentage. I don't know why it was named that, but this is a pip. So when we take a look at currencies, when we take a look at, again, currencies, dollars and cents, someone has decided years ago that the 4th decimal number is going to be called a pip. And so when we talk about when currencies are moving, we talk about them moving in pips. So if this currency pair moved up to 115.400, that would have moved 2 pips. It would have moved 2 pips higher because 8, 9, 10 went up to 2 pips. If this was to go down to 115.35, it moves 3 pips lower. As you can see here, this is where we have dollars and cents, and that's the amount of pips they're worth. So you can see this 15 cents here is actually worth 1,538 pips. So if this was at $1, if this currency started at 1.0000 and rose to 1.1538, you would say, wow, that moved 1,538 pips. Now, when I started out, this was all you got. We didn't have any numbers past the 4th number, past the pip. They added in another one, which is great because now we're cutting spreads even more. And this is known as a pipette. So just a smaller pip. Okay, so in currencies, you're going to find out that a lot of the rules that we have work across the board except for one currency. And this one currency has so many little different rules. And so we have to always discuss how the yen is different. The yen is different. So the yen, this is the exchange rate between dollar and yen. So for $1 US, you get at 115 Japanese yen. Because of this high price, then they've decided that this is the pip. We're going to trade yen in dollars and cents, not anything else. But because the yen is such a high exchange rate, we're going to consider this as a pip. So whenever we take a look at yen, we have to have a special rule for yen. The yen basically trades in dollars and cents, just like everything else. I can't explain why. I can't explain who made these rules, but these are the rules for currency trading. The yen has lots of special little rules that you're going to learn here over the next little bit. Let's talk next about margin. Now, for those of you that trade in stocks, you know that margin is a loan from your broker. And it's really no different here. Now, margin is, yes, it is a loan from your broker, but really what it is you are allowed to take a position. And you don't need to come up with all the money to take the position. And your broker says, hey, you just need to come up with $2,000 and I'll let you hold this $10,000 position. So it's not technically a loan, even though it will be a loan and they will charge you margin interest in stock trading. But in currency trading, it's not a loan. It's really escrow. It's really, okay, you want to trade a $10,000 position. We'll let you do that, but we need you to put up $2,000 in margin. And that is basically escrow, saying, okay, well, you have a required amount that's locked up. Now, you can't use that money for any other position. It's locked up. If you have more than $2,000 in the account, you can trade more positions, but just you can't use that $2,000. That's what's being held to secure that position. Now, each broker provides its own rules. So this is where there's really no uniformity other than the government mandated rules, which in the United States is 50-1. This used to be 100-1 until the Dodd-Frank Act of 2011-2012 moved this from 100-1 down to 50-1. Every country will have different margin rules for their brokers. Yes, there are still some countries that allow you to have 200-1, 400-1. At some point, it's ridiculous. At some point, that's way too high, and just one trade will blow you out. So anything past 50-1, you don't want. You don't want it. It's more risk than you should be able to take. And if you are a disciplined trader, you would never use that much leverage. And if you would never use it, then you would never need to even have it available. So beware of anywhere that has 200-1, 400-1. Look, if you're disciplined, you'll never use it. If you're undisciplined, it will kill you. So in the US, it's 50-1. We trade through Interactive Brokers. Interactive Brokers is actually even more conservative at 40-1 for most currency pairs. If you want more information, jump onto Interactive Brokers' website and just type in what are the margin rates for Forex, and they'll show you these are the current margin rates. Now, these margin rates can change over time. I remember during Brexit, when the pound was very volatile, Interactive Brokers actually moved the margin down to 20 to 1 on the pound. And I think at one point at the worst, it was moved down to 10 to 1. So they have the ability to move these rates anywhere they want based on the volatility that they see in the underlying. So let's just take a look at an example of a trade. So let's say that I'm looking at Australian dollar, and we're going to go through our relative strength, how to determine relative strength and weakness. So you're going to look through all the currencies, and you're going to say, wow, I think Australian dollar looks the strongest. And then you look at all the currencies and say, wow, I think US dollar looks the weakest. So that's going to be the right pairing you want to take a look at. Now, once you get the pairing, you're going to have your entry point. That's going to be in later sessions. Don't worry about that. But let's just say the entry point here is 71.65. That's the current price of the Australian US dollar cross. Okay, so if you buy 100,000, let's say you put that in your system. You go in, you put in Aussie US dollar, and you put in, I want to buy 100,000. Okay, let's understand what it is you're actually doing. You actually want to buy 100,000 Aussie dollars, and you're doing it with your base currency. Now, since this trade is in US dollars, and we're going to trade here in US dollars at Maverick, then it's really pretty simple of just doing some quick math. You multiply your position size by the exchange rate. So this position is $71,000 worth. So basically what you're saying is, I want you to exchange 71,650 US dollars for 100,000 Australian dollars. So this position size isn't $100,000 worth. And that's one of the very first mistakes people make. They don't understand, no, we have to do this conversion. So this is a $71,000 position. So that's what we hold. We hold $71,000 worth of US dollars of Aussie dollars. And we're going to make a return on that amount. So let's say that this currency pair, well, let's go through the margin rate. So let's assume there was a 50 to 1 margin rate. It takes our 71,000 by 2%, which is 50 to 1. And you can see that your broker would say, okay, to make this trade, you need to lock up $1,433. Okay, so that's what the leverage does for you. Now look, this trade is either going to do one of three things. It's either going to go up, it's going to go down, or it's going to go sideways. That's it. That's amazing, isn't it? That's what happens in trading, up, down, or sideways. So in this example, let's say the position went higher. So the position goes higher, and we exit the position at 72.20. So we went long at 71.65. We exited at 72.20. So let's get our percentage return. Now look, we're going to talk about pips all the time. Okay, this trade made 50 pips. This trade made 70 pips. But understand that we are actually wanting to think about percentage return. Pips are just a very easy, fast way to say, okay, I bought it here, I made 100 pips. But really, understand that 100 pips on the Aussie dollar, which is at 71 cents, is vastly different than 100 pips on the pound Aussie, which is valued at somewhere around $1.90. Do the math. 100 pips on $1.90 is basically like 0.5%. 100 pips on 71 cents, that's like 1.4%. So we really want to be thinking in terms of percentage return. We're going to talk pips. This is just how we talk, dollars and cents. But really, what you made was the percent. So if you made 55 pips, which is 0.0055, you divide that by the cost, you're going to get your rate of return. So the rate of return on this trade was 0.77, so just under a 1% return. So we take our position size of 71,000, times it by our rate of return, and then we get to our gain. So this was a $551 gain. So that's a really nice gain, especially when you take a look that you had $1,433 of margin that was tied up. Now look, this works the other way. If this trade went down 55 pips, this would be a $551 loss. All right. Now, for those of you that don't love math, don't worry about it. Don't worry about it. They're calculators that do all this. And I've got to say that it gets fairly complicated when you get into the, I'm going to call them exotic crosses. Things like the Kiwi Swiss franc cross. Because remember, we're trading in dollars. So what you have to think about, you would have to do, if you were to buy Kiwi Swiss franc, you would literally have to exchange your dollars into Kiwis first. And then you would exchange it into Swiss francs. So there's actually going to be some more math put in here. You would have to do the calculation we just did and then take the Kiwi US dollar cross and then make that, and that would show you how much your position size was. I'm going to recommend that you don't worry about that and that you use online calculators. So in our tools section in our website, you could go onto the tools and there's going to be pip value calculators. There's going to be position size calculators. There's going to be all these tools to just, you plug in your numbers and it just spits out, okay, this is what this position's worth. This is what every pip is worth in dollars and cents on your trade. Use the calculators. Use the calculators. Now look, in US dollar pairs, it is fairly easy. Every pip that is moved up or down on a one lot trade on $100,000 is equal to $10. So if you had a 100,000 position of euro dollar and it moves up one pip, it's $10. If you have 10,000 position, it's worth $1. So all US dollar denominated currency pairs, pretty easy to figure out. But when you get into the exotic ones, you definitely want to use the calculators. So when it comes to Forex trading, here we have the 8 major ones. Your job as a Forex trader is to identify times when one of these currencies is strong and when one of them is weak. And then you put them together. Now, people always say, Rob, what's the best trade? Well, that's a very easy question, and we covered this in pairs trading. The best trade is when you buy the currency that's the strongest and sell the weakest during that period of time. So let's say you want to make a trade and you want to hold this trade for the next 8 hours. At the end of 8 hours, you're going to be able to go back and see what was the best trade I could have made during that time. And the best trade was the pair with the largest differential. So let's say that during that 8 hours, the strongest currency during that 8 hours was the dollar, and the weakest was the Canadian dollar. The best trade you could have made during that period was dollar CAD. That was the best trade you could have made. Now, let's say you didn't make that trade. Let's say you did dollar yen. It doesn't mean that you didn't make money, but let's say the yen was in the middle of the pack. Let's say the dollar was the strongest and the yen wasn't the weakest, but it wasn't strong either. It was like in the middle of the pack. You still made a nice gain. You just didn't make the best trade. I want you to understand right now, very rarely are you going to make the absolute best trade of all the combinations. It's going to happen sometimes, and it's awesome. But understand, that's what you're attempting to do. That's what we're trying to do on every single trade, is we're trying to identify during our time frame that we're going to hold this position, what currency is going to do the best and what's going to do the worst, and that's our currency pair that we trade. So it all comes down to relative strength and weakness, and we're going to spend a lot of time on helping you develop your own relative strength and weakness scoring system, where you're going to analyze these 8 currencies, you're going to give them all scores, and whatever score has the highest, that's the one you're going to be long. Whatever score has the lowest, that's what you're going to be short. And you're going to be able to have pairs that you're going to be looking at during the day, during the week, during the month, based on this analysis. So let's review everything here. There are 8 major foreign currencies that we are going to focus on, and that's it. We're going to focus on these 8. Yes, I know there's other currencies out there. They are going to be very risky and very expensive for you, And there's probably one of the 8 major foreign currencies that's already highly correlated with it, which means it's going to move about the same way. Every single time I have a trader that asks me, Rob, what about the Turkish lira? What about this? I can show them that there's a correlated pair that does pretty much the same thing as that lira, plus or minus the huge volatility, huge bid-ask spreads, and large slippage issues. So focus on the 8. There's going to be plenty of trading opportunities with those 8. You're just going to have to learn the dominant versus recessive currencies. It's pretty easy because once you learn it once, it's a no-brainer and you have it for the rest of your life. And we've got watch lists that you can look at and build, take a look at. It's really quite easy. You just have to remember to be long or short. You're just simply long or short. So if you want to trade the recessive, you're just going to short the dominant pair. And in the end, yes, we're trading these currency crosses. But just like everything, a stock, a bond, a future, cryptocurrencies, foreign currencies, in the end, trading is trading. And everything is simply a symbol. And that symbol has a current market price of what its price is today. And that price is going to move up or down based on the changes of supply and demand. So what you're really trading isn't all that important. It's really understand that price action is going to move this up and down, and as traders, we're going to try to profit on that price action. Right, thanks for joining me. I'll see you in the next session.